Hey, it's KP coming to you live from Corona, California. Thanks for subscribing to the channel and banging the like button on KP Talks Dollars and Cents. And I want to thank all of our subscribers on the YouTube channel, KP Talks Dollars and Cents. If you put some comments down below after you bang the like button, we're going to read them. And maybe that information and those requests will be topics on a future episode. So please stay engaged. It's very much appreciated. Thank you very much. We got a big week to recap from last week and another one coming up as we finish off the holiday season. And by the way, happy Hanukkah for those that celebrate. It just started yesterday. And then of course, next weekend we've got Christmas and then New Year's. So we usually start off going over a recap of the news that's relevant and as of late. And then we'll get into another couple topics. And one of them I want to talk about today is how a recession is actually good for you and your money. So last week was really market moving, super important. We had tons of data coming out. And remember, our Fed is driving the bus on the fight of inflation. The Fed has decided to raise the federal funds lending rate by 50 basis points. And that was a big market mover. So on Tuesday of last week, the CPI, the Consumer Price Index, came out. It was actually a positive for markets. Consumer Price Index basically talks about the cost of goods and services that you and I pay for every day. That number comes out once a month. And trust me, everyone around the world is watching the CPI number. I contend that the Federal Reserve Board probably has access to that data before you and I do. So they know what's coming, and that helps formulate their thoughts. The CPI data that comes out is housing related. Housing. So there's rent, there's owner's equivalent rent, and then there's away from home lodging. These three components make up a really large portion of the CPI number. Let's just call it 40%. We know that new leases are getting a little less expensive. We know that home prices are getting a little less expensive. And maybe lodging away from home has not really rolled over and it's still about the same cost because a lot of people are traveling, especially during the holidays. So the CPI data that came out last Tuesday was a positive. It was a net positive because inflation is coming down. And this is the first time we've had two monthly CPI reports in a row where inflation was less than expected. And that's a huge thing. Now, I don't think it's any coincidence that the very next day when Chairman Powell spoke, that the Federal Reserve only increased by 50 basis points instead of 75 basis points. So there have been about 4 total points, 400 basis points of Fed rate hikes since March. And they've gone 25, 50, then 4 sets of 75, and then this last one down to 50 basis points. That's a big deal. That's a sign that the Federal Reserve's tightening cycle is coming to an end. That's good for really sensitive interest rate driven economies like housing, like car loans, any kind of loan that's tied to an interest rate. So if the tightening cycle is getting closer to an end, there is more certainty in the markets. So what happens when inflation comes down? What happens when the Fed stops raising rates? Markets feel good about investing money. You and I feel more confident. There's more certainty. Institutional traders and buyers, the massive billions and trillions of dollars, they feel good about maybe taking more risk because there's more certainty about where the economy is going. Now, there isn't certainty about whether we're going to be in a recession or not. We don't know when and if that will happen. We may already be in one. We may have already experienced one. There may be more pain to come if there are more job losses. Some more certainty came on Thursday. Another really big data point came out. Retail sales number for November. Now, why is retail sales important to you and I? If consumers are spending less, the economy is shrinking. And we finally had a data point where there was negative growth, not just less than expected growth, actual negative growth of retail sales month over month from October to November. That's huge. We did talk about Black Friday being epic, the best Black Friday ever, and Cyber Monday being even better and being the best Cyber Monday ever, larger than Black Friday. Even with that, the month of November retail sales was down. It decreased month over month. That is a huge sign and red flag that we may be entering a recession or are already in a recession. So a lot of times determining whether we're in a recession or not is happening later on down the road when all the economists and talking heads get their data finally out there and they go, oh yeah, that Q4, that was a recession. We'll talk about recession and how it could be good for you knowing these kinds of data points in just a second. Now that we've talked about the retail sales data and how huge it was for the recession watch, what happened in the markets? The stock market is a huge barometer of how things are going with money. Some companies may not be recession proof. If there's going to be less sales out there, some companies may not do well. That could impact the price of stocks, impact your investment, my investment, your savings. If you saw what happened last week in the stock market, when the CPI print came out on Tuesday, it was a positive thing for the stock market because that was another great sign that inflation was coming down. Then the retail sales data came out on Thursday, which was a red flag for potential recession, which was another data point that said, hey, maybe stocks are a little bit too risky. Maybe this recession coming is going to hurt. These are things you have to watch when you're thinking about managing your money. All in a week's time, that happened. And there's a lot of volatility in the market. So there are people that are short-term traders that are really going up and down with this kind of week-to-week, day-to-day, minute-by-minute data flow. Now, there are most of us who are investors. We're putting our money to work with a longer time horizon. Maybe you're saying, I'm going to invest in a great company like Apple. Maybe the supply constraints or the COVID lockdown policies in China have hurt sales for Apple. But long term, I like that company. It's a great brand with tons of free-flowing cash. And even though it's come down a little bit, maybe now's the time to invest in Apple because long term, I think it's going to be a winner. It all depends on whether you're investing or trading. I'm not advocating for either. I'm just pointing out information that can help you make a choice in what's best for you. Okay, let's talk about recession and how it's actually good for you. Now look, if job losses are happening, and that's the last shoe to drop to cause a recession in 2023, of course, if you lose your job, that's awful. But there's over 10.3 million jobs open right now in America. There are ways to go out and find a job. So the Fed is watching the labor market. They went from over 11 million jobs open to an expected 10.7 on the last job opening reading, down to 10.3. Still a lot of great job openings, but it's less good news. Then the weekly claims that come out every Thursday, which is data you and I can look at, have been generally steady. They actually went down last week. But continuing claims, people that have claimed a new claim of being jobless and stay that way, has been steadily rising. We've gone from 1.5 to 1.6 to 1.7 million people. So those are bad things about a recession, obviously, but if you are still gainfully employed and you're looking to put your money to work, thinking about what to do with buying a home, especially if you're a renter, or maybe you own a home and you want to get the next big one. Recessions are good for you because if inflation is coming down, number one, your real wages, the power of your income, your wages that you make, actually goes up. Inflation is an invisible tax on the goods and services that you buy every day. It erodes your buying power. If inflation's coming down, for example, oil prices coming down, and your heating bill, when demand in our economy comes down, for example, on the retail sales report that we saw last week, if real demand is coming down and inflation is coming down, your dollars you earn go further. They can help you do more. And so what we've seen the last few months in our economy is people switching from buying goods to buying more services and experiences. People were buying goods during COVID because they were locked down. They couldn't go out and spend their money on going to dinner, going to the movie, traveling. Well, now it's flipped. Towards the second half of 2022, people are now spending more money on services, which means going out to dinner. Leisure and hospitality spending went up on this retail sales report. So the retail sales report was negative overall, negative growth for November, but not for hospitality and leisure and services. And of course, the jobs reports we've been watching have been matching that. The jobs that are open out there and the jobs that have been gained and are for leisure and hospitality. You and I have experienced that this entire year. How many times have you gone to a restaurant and you felt the service was kind of lacking? It's been hard to find good help. It's been hard to retain good help. So many people, great people that are working in the services industries, they're working double shifts, they're working super tough hours because it's hard to find good help. And so we're noticing that. That's a good thing for your real wages if goods, inflation prices go down, the power of your wages in dollars goes further, and people are spending it. And if you're saving, by the way, you now are getting more and more money paid back to you in interest from your savings and checkings accounts. When we had zero Fed funds rates, you were not making anything. You were actually losing real money because inflation was going up and you were earning zero interest rate in your checking accounts. Now, the inflation rate is coming down, and thanks to the Fed raising the Fed funds rate, savings rates are going up for your checking and savings accounts or your money market accounts. That's another positive thing about recession. What is a good way to get into and get started in the stock market or in housing? Are you waiting for the bottom? We're going to talk about the difference between the bottom and a tradable bottom. Let's talk about getting started first, because most people, their biggest problem is just getting started. When it comes to buying a home, people are looking for a deal right now. How do you know what your buying power is? There are so many myths in housing. I could get into all of them about your credit card debt and how it's not as bad as you think, how monthly debt is what's looked at by mortgage lenders, not your overall debt. I could give you those tips. They're very cliche. A lot of housing videos out there, they talk about these points, and I can get into them. But I want us to be a series more about action and mindset. One of those things is when to get started. If you're ready to own a home and you're ready to get started, you need to call a local originator. There are so many out there. I could talk about so many that I know. I don't even want to talk about my own company. I advocate local originators. That's the way to get started. You gotta just reach out to someone locally and have that conversation. What's my buying power? Don't wait until everyone sees the same data that you and I see every day. Are you waiting for the bottom of rates and the bottom of pricing? Do you think we're in a bubble? We're not in a bubble. This isn't 2008. We aren't having a credit collapse. This is just a simple market correction. We're in this between zone between having an epic economy, a huge refinance boom, to are we in a recession yet? Are we going into one? That little in-between zone is usually the worst time for housing. We have been in a housing recession, and we're usually the first ones to lead the economy out of a true broader recession. So getting started as it relates to housing really involves contacting a local originator today. That's what you should do. If you need help doing it, click down below. Happy to help you do that. Now, what's a great entry point to getting into the market? What are you doing with your cash? Now, remember, I am not a financial advisor. I am not responsible for your losses, only your profits. But if you really want to get with someone to help you invest money, I do recommend a financial advisor. I have a network of those as well, and we love for them to be part of the show and put comments down below. A financial advisor can help you come up with a game plan, but you can't if you don't start conversations. A conversation is not a commitment. That's why we do these videos. It's basically a conversation between you and I and everyone that produces this channel to make sure that we help you and your family for generations to come. All right, let's talk about the bottom versus a tradable bottom. What does that mean? Everyone thinks they can time the bottom, but it's really hard. As soon as it's the bottom, boom, everything rips higher, right? There's really smart money out there with tons and tons of money to invest in housing. They are the ones that when they feel, hey, this is where I'm gonna put in billions, if not trillions of dollars at risk, we can't compete with that. That wave of money that comes in is so great that markets tend to rip higher very quickly. Sometimes we're sitting on the sidelines trying to time the bottom and we missed it. And then we see a market go up 15, 10%, 5%, literally in a day to a week to a month's time. And you think, oh man, I missed the best time to buy my stock, my company, my home, whatever the case may be. And then you feel a little dejected and then you sit back. But the reality is, if you don't time the bottom, that's okay. The bottom is usually a sign that going forward, things are gonna get better. And if you're renting, remember, every single day, you're making a landlord rich. It's always a bottom when you're renting. So you got to get into a house. So let's talk about a tradable bottom, right? There are times when you see in the stock market really great companies out there. You're like, I would love to get into Apple. They're at their 200 moving day average. They're at a 52-week low. That could be a great tradable bottom. I'm not advocating for Apple. I'm just using it because it's such a sure bet in many investors' minds. It's such a great company. Remember in the last episode, we talked about dark pools. It's a name given to exchanges where large investments are made. You know what happened in the last week since we talked about dark pools? Elon Musk sold some of his Tesla stock, $3 billion in Tesla stock. Since we brought up literally in the time of our last episode when we talked about dark pools, the effect of him selling massive amounts of Tesla stock is the price has been coming down. As of this taping, Tesla stock is down 60% year to date. So you and I can't time these things. We don't know when these things are going to happen. We can't pick the bottom. But I can tell you, the seasonal trends of this market and next year's projections for the mortgage market is over $2 trillion of mortgages getting done. $2 trillion in exchange of real estate. That's a big year. And in the spring purchase season, when people come out of the woodworks, after Hanukkah, Kwanzaa, Christmas, New Year's, they go out and they start hunting for homes. And if mortgage rates continue to come down as they have been, and home prices continue to come down as they have been, there'll be a bottom. Will you miss it? Will you miss it waiting for the glaring signal? Or will you take my advice and say, you know what? The timing for me is good. Getting pre-qualified today is good. I can shortcut the bottom of mortgage rates because I can do a 2-1 buy down and then refinance later if rates do get even better than when you got into the loan. All you gotta do is wait 6 payments and then refinance for most of your lenders. Home prices generally appreciate about 5% a year. Are you willing to wait all next year for maybe 5% of the price coming down, maybe 10, when you could have gotten your dream home in front of the line that's coming and then get into it and not risk losing that 5 or 10% appreciation over the next 1 or 2 years? I'm not gonna tell you I told you so. That's not my style. I want to tell you, I'm telling you now to get out and get out in front of it. I hope this helps you and your family. Thank you so much for watching this week's content. It's gonna be an exciting week. I hope you're thinking about what to do with your money and you're trying to find financial freedom. Please, thank you for subscribing to the channel, bang the like button, and hopefully you and your family are better served for it. Thank you.